the biggest bank collapse since the 2008 financial crisis, and it shut down today.
And in the last 24 hours, many founders, investors that I've talked to have been desperately trying to get their money.
Just hours earlier, the Silicon Valley Bank collapsed on Friday, and authorities seized the assets of...
This is the biggest collapse of a financial institution in America since that crisis of...
Hi everybody. On the 10th of March 2023, the US regulators made a shocking move by shutting down and taking control of the deposits of the Silicon Valley Bank, which was the 16th largest US bank. The Silicon Valley Bank became the second biggest American bank to fail after Washington Mutual, which collapsed during the 2008 financial crisis. Many feared that this could trigger a deeper recession similar to the one experienced in 2008. But with the timely intervention of regulators, the impact was contained, preventing the devastating impact on the global economy. The dramatic end of the playmaker of the startup ecosystem came 2 days after it announced the sale of the government bonds. It also failed to raise enough capital to handle the massive withdrawal request. The company broke the news on Wednesday, and by Thursday its share price was down by 60%. The share price was down another 62% in pre-market trading Friday, and it never returned back for trading. The bank's failure was not due to the involvement in risky investments like crypto or the misuse of its depositors' fund unlike FTX. Instead, it was a case of a classic assets-liability mismatch triggered by poor management decisions. And many experts agree that the collapse could have been avoided had the bank communicated clearly to its core customers about its financial position, which was actually very strong when regulators took over. In this video, we will dive deep into how the 16th largest American bank became a victim of its own wrongdoing. We will also explore the lessons that we as a business enthusiast can learn from this unfortunate event. So stay tuned to find out more about this shocking incident and the valuable lessons we can learn from it. Founded in 1983 and headquartered in Santa Clara, California, Silicon Valley Bank had been helping startup companies secure loans when they could not get one from established banks for over 40 years. In fact, according to Reuters, nearly half of all US venture-backed technology and healthcare companies listed on stock markets in 2022 had Silicon Valley Bank as its partner. So, what made Silicon Valley Bank so unique and popular among startups and venture capital firms? Its business model was fair and straightforward. Startup founders could simply borrow loans from the Silicon Valley Bank by pledging their shares, which ultimately became its unique selling proposition. Eventually, for VC firms, having a bank account at Silicon Valley Bank became a mandatory point in the funding contract rather than an option. But there was a hidden risk behind this business model. To understand this risk better, let's take a closer look at startups and their relationship with venture capital firms. Startups are essentially cash-burning machines. Even promising startups take years before they can generate enough revenue to sustain themselves, and that's where VCs comes in. These firms provide the necessary funding to keep the lights on during the cash-burning stage. In other words, startups rely heavily on venture capital firms to survive. A single startup can raise money from multiple venture capital firms, and more VCs means more money for the startup. Promising startup can raise hundreds of millions of dollars from one or multiple VC firms. It sounds great, right? But what happens if these venture capital firms start to pull out their funding? That is where the risk lies. Silicon Valley Bank's main business came from these startups. Its main business was to collect deposits from startups financed through venture capital firms, and as long as the funding in startups continued, Silicon Valley Bank would continue its business as usual. The problem would only come if the funding dries, and that is exactly what was happening for the last 1 year.
Getting capital for an early-stage startup is crucial if an idea is going to grow into a full-blown business. And venture capital has typically been there, ready to invest. But there are signs of a pullback. In the second quarter of this year, VCs invested around $16 billion in US early-stage deals, typically called Series A and Series B rounds. That's according to data from PitchBook. It's a 22% drop from the same time a year earlier, and the biggest quarterly year-over-year decline in early-stage funding.
To understand this, let's rewind a bit to the early days of the pandemic. When the pandemic hit, many tech startups feared that it was the end. Likewise, venture capitalists also warned of a bleaker future. It was true for the first few months of the pandemic. While physical businesses such as retailers and restaurant businesses struggled to survive, tech startups, on the other hand, were booming. Demand for tech startups offering virtual learning and meeting, e-commerce, video games and streaming and productivity softwares reached a record height. And venture capitalists welcomed that growth by investing billions of dollars. According to CV Insight's report, startups around the world raised around $621 billion in 2021, which was more than double the previous record of $294 billion raised in 2020. If you look at the share of the US startups, they raised nearly $330 billion in 2021, which was roughly double of $167 billion raised in 2020. That's not all. VC firms also made headlines for raising billions of dollars. According to PitchBook, US VC firms also made a record in 2021 by raising $128 billion, which was an increment of around 50% over 2020's fundraising figure of $86.9 billion. Besides rising demand for the services offered by these tech startups, there was another major factor that fueled the growth of startup financing, and that was the low interest rate, which is determined by the Federal Reserve. But as we have seen, this growth could not last forever. As the demand and the funding in the startups ballooned, so did the deposits in the Silicon Valley Bank. In 2018, it had $49 billion in total deposits. Fast forward to 2020, deposits grew to $102 billion. And 1 year later, in 2021, it had around $190 billion in total deposits. As you probably already know, banks make use of those deposits in various ways. One way is through loans, but they also invest in government securities, which are considered one of the safest investments out there. But for Silicon Valley Bank, these safest government securities eventually became a reason for its downfall. Now, let us understand these government securities, or also known as government bonds, first, so that it would be easier later to know their role in the collapse of the Silicon Valley Bank. So what exactly is a government bond? Well, it's a debt security issued by the government to support government spending and obligations, and also to control the money supply. Government bonds typically have a maturity period that ranges from 10 to 30 years, during which the bondholders are paid a fixed amount of interest annually or semi-annually. One thing to note is that the price of the bonds and the interest rates have an inverse relationship. This means that when interest rates rise, bond prices usually fall, and when interest rates fall, bond prices usually rise. Here is an example to explain the things mentioned above in the simpler terms. Let's say the US government issued a 1-year bond that will pay you $1,000 at the end of the maturity period, which for now is 1 year. Essentially, this is a zero coupon bond because it pays no any interest, and this kind of bonds are generally issued at a discount. For this exercise, let's assume that this zero coupon bond is trading at $950. If you invest $950 today, you will receive $1,000 at the end of 1 year, earning you a return rate of 5.26%. As an investor, you would always want to maximize your returns, right? After exploring the bond markets, you knew that new bonds are offering an interest rate of 10%. In this situation, the demand for zero coupon bonds, which has a 5.26% return rate, will decrease. To increase the demand for the zero coupon bond, its price has to decrease enough to match the return generated from the prevailing interest rate. In this case, the price of the bond would drop from $950 to $909.09. But what if the interest rate dropped to 3%? Here, investor would prefer the zero coupon bond because it offers a 2.56% extra return compared to the new bonds. So the demand for the zero coupon bond increases, and the bond price would increase to approximately $970.87. That's why bondholders would benefit when the interest rate decreases, but suffer a loss when the interest rate increases. Now, let's get back to the Silicon Valley Bank. As the deposits grew in the bank, it invested some of that deposits in government bonds. At that time, long-term government bonds with maturity periods of 10 to 30 years were providing higher interest rates than shorter duration bonds. So it was obvious for Silicon Valley Bank to invest in those longer-term bonds. It ended up investing around $95 billion. According to one research report, its total investment in long-term government bonds accounted for 75% of its total debt. This is the point where the bank miscalculated the risk. Now let's see what those risks are.
Startups are a risky bet in the best of times, but when interest rates start creeping up, they get even riskier. Interest rates represent the cost of borrowing money, and fast-growing tech companies need to borrow a lot of money to keep growing, and in some cases, to stay alive before their business models can start turning a profit. And with the Fed hiking interest rates in order to fight inflation, that means riskier areas of the financial system, like crypto and tech.
The first risk is interest rates risk. In our previous example, we saw the relationship between the interest rates and the price of the bonds. Silicon Valley Bank purchased government bonds before the interest rates started going up. If the interest rates go up, the price of the bond that the bank purchased will go down. So if it had to sell those bonds, it would have to sell at a loss. The second risk is high concentration on startup funds. Actually, this risk is also tied up with the movement of interest rates. Startups raise billions of dollars in the era of low interest rates. If the interest rates go up, it will increase the cost of borrowing for businesses, including venture capital firms, which are the main source of funding for startups. This will increase the pressure on the Silicon Valley Bank in two ways. First, its core business of collecting deposits from startups will dry up. Second, with no new funding, startups will start withdrawing to fund their daily operations. And if the bank does not have enough liquidity to meet the withdrawal request, it will be a big problem in itself. For Silicon Valley Bank, the problem started with the reduced demand for startup services. As the pandemic subsided, people slowly started returning to their normal life. And as more and more people started leaving their homes, the demand for tech startups offering grocery deliveries, online meetings, and gaming started fading. Even startups which are preparing to go public began to cut back their valuations in light of reduced demand and revenue. The problems of Silicon Valley Bank did not stop there. The American government started to increase the interest rate to control inflation, and the increase in the interest rate proved to be the final nail in the coffin. With the rise in interest rates, Silicon Valley Bank started having problems we just discussed. Venture capital firms slowed down their investments and startups began to withdraw more money from their accounts. Both actions squeezed the cash reserves of the Silicon Valley Bank, which had failed to consider any such types of risks to occur in the future. Had it considered these kinds of trouble, it would not have invested heavily in long-term bonds, because it would not be easy to get that money in an emergency situation like this. As a result, Silicon Valley Bank soon ran out of cash. As most of the cash deposits were locked in government bonds, it started having problems meeting the withdrawal request of the startups. On the other hand, government bonds were also losing value because of higher interest rates. As the last resort, Silicon Valley Bank was forced to sell some of its bond holdings at a steep discount. In total, it sold around $21 billion worth of its securities for a loss of $1.8 billion. The US government bonds are considered to be the most secure investment in the world, and that is because the US always pays back its debt obligations. Unless the bond investors need to raise cash quickly for an emergency situation like SVB was facing, the sale of the US bonds before maturity is often the harbinger of the worst situation. On March 8, 2023, the bank announced the loss from a sale of US bonds, which spooked investors to lose confidence in the bank's liquidity position. Even the reassurances from the bank's executive about its strong balance sheet failed to restore confidence, and depositors withdrew more than $42 billion from the bank on March 9, 2023, causing a run on the bank. At the end of the business day on March 9, the bank had a cash deficit of around $958 million. The following day on March 10, 2023, US financial regulators shut down the bank and took control of its deposits. The journey of a 40-year-old company, which was the driving force of tech innovation, suddenly came to an end. The fallout of the Silicon Valley Bank brought to light the significant role that lax regulations and the high-risk appetite of its executives played in the bank's collapse. In response to the 2008 financial crisis, the US government enacted the Dodd-Frank Act to regulate big banks to ensure that they hold certain capital reserves for emergency situations. However, the bill's stringent regulations were removed in 2018 after Mr. Trump signed a new bill. Surprisingly, Greg Baker, who was the CEO of the Silicon Valley Bank during the fallout, was among the strong supporters of the bill. Hence, this fallout has also raised questions about the role of executives and their responsibilities in ensuring proper risk management and adherence to regulations. The failure of Silicon Valley Bank has taught us all one very important lesson about investment, and that is diversification is key. You see, Silicon Valley Bank had a lot of exposure with tech startups, and that turned out to be a big mistake. It needed to diversify its customer bases just like big banks such as JP Morgan Chase and Bank of America have, which have a huge retail customer base. And that's not all. Silicon Valley Bank also made another big mistake. It did not diversify its investment enough. It invested heavily in government bonds, but when interest rates rose, it turned out to be a big disaster. Well, if you already own or plan to own a business, make sure that your revenue source is as diversified as possible. And the same goes for making investment decisions too. Don't put all your hard-earned money in similar kinds of investments. Spread your money out and invest in different things so that if one investment fails, you won't lose everything.
This much for in this topic. If you think that this video has added something valuable to your learnings, please make sure that you hit the subscribe button so that you won't miss a future content in similar topic like this. Thank you for watching. I'll see you in the next one.